Sunil Subramaniam, CEO of Sundaram Mutual Fund is with us. Thank you so much for joining us, sir. As usual, pleasure having you here. Today, I'm just going to avoid focusing on sectors and what is going to happen. I just want you to tell us that you have the experience. You've seen such markets where markets go up very sharply and then they consolidate, people get worried, they hear contradictory things from their brokers saying, "Nahi, nahi, market to abhi upar jayega," or someone says, "Bech dijiye," right? What do you've seen it? What should our viewers do in situations like these?
I think the key thing I would say is from a retail investor's perspective is stick to the SIP form. And the reason for that is that the overall scenario, while it looks very good, there are ample opportunities for news flow and liquidity driven corrections in the coming months and weeks. And so the best way to actually take a good position in the market is through gradual allocation. So either you are doing through SIP or you are doing through buying on corrections systematically. So you basically start a core SIP and then use lump sums to enter whenever market has a strong correction, because news flows are going to be giving you wonderful opportunities for corrections to buy in. But on a long-term strength, underlying strength of the earnings growth, underlying strength of the GDP of the economy, and the fact that advanced countries are not yet looking back on a growth path, which means that foreign liquidity coming into Indian markets is also going to be healthy, means that overall it's a good time being in the equity markets.
Obviously, you have a huge number of people who put money with Sundaram Mutual Finance. You have a great dividend payout record. You actually pay out money regularly. Tell me one thing, when people see markets go up like that, do you see higher redemption pressure? Do you see people now changing the way they used to operate? Do they start saying, okay, I want to take some money out now?
Oh, that's changed. The previous boom cycle, what you said happened. You know, the previous boom cycle, there were lots of people who had come in on the back of a lot of stories, and when they made good money, they backed out. But now we are seeing that the one big change in the mutual fund industry, and it's true for our fund house and I'm sure for a lot of others, is the composition of SIP flows into the regular flows. That has gone up a lot. And when you're in an SIP mode, you're not looking to book profits, right? So that's one. The second thing is that when you build up a good dividend track record, then customers also sit easy, because whenever there's a correction, and last week if they got a credit into their bank account, they are feeling that, oh, the fund manager has booked profits on my behalf, so I don't need to worry. So the dividend actually talks to the investor's behavior in a very, very strong kind of a way. The third thing, yes, there are HNIs who do profit booking, and this generally happens a year into a bull run, because 12 months is the equity taxation when you get long-term tax gains free, right? So there are a set of people who are HNIs who are, say, between 12 months to 15 months, they do look at the portfolio, see, have I made good gains? Is it time to reallocate between equity and fixed income, or between large caps and mid caps? So that proportion of the market, which is people who have a lot of money, who take some time to study the market, and who want to be active managers on their own of their mutual fund portfolios. That's a human element which you can never avoid. So you definitely see that in those sectors, in those spaces where there have been huge gains in about a year's time frame, people do reallocate portfolios either within equities or within the equity fixed income basket.
So that must be putting a lot of pressure on fund managers, right? In how to allocate the money, because they really can't control the inflow. They can only, and they have to have some outflow, as you said, that if they don't give back dividends, then the customer, your subscribers, the customers, those who are doing SIP, it's difficult to retain them. So how do fund managers deal with situations like this?
Yeah, so the basic thing is that we need to have a tracker. So at our fund house, for example, we do a tracker. We have a tracker of how much of the corpus came in a year ago. And so what is the propensity to redemption that generally occurs? And you know, you can put patterns around these. Like, for example, direct investors are more likely to redeem because they are obviously trying to take charge of their portfolio. Right. You have high wealth boutiques who put in money, who are also constantly actively managing. So if you classify the funds and look at the institutional stroke HNI component and track that to a 12 to 15 month, what we generally try and do, and we also have a trend pattern in terms of each fund gets a certain SIP flow every month. So we kind of sit and do an internal planning. Okay, next month, if in a particular fund, let's say mid-cap, we are going to get in, let's say, 25, 30 crores in SIP flows. And we see that there's about 50, 60 crores, which is completing 12 months or in that 12 to 15 month bucket. So what we try and do is, and the third thing which also happens, right? I'm saying this is in terms of keeping a higher proportion of cash at that particular moment to meet this. That's all that matters. And what happens is, in a situation like today where you also have fresh IPOs coming in, you anyway also need to generate cash to invest in IPOs. So I think it's just that you slightly increase the cash component that's there, because you don't want to be actually selling a mid cap or a small cap stock just because there is pressure and not when you think is the right time to book profits in it. So this is a fund management. It's a kind of very scientific process that we follow to manage this, so that the rest of the investors, either you're talking about the growth option investors who stay or even long-term SIP investors, don't really suffer because of the actions of a few institutional investors.
So what's the ballpark breakup of retail versus HNI and institutional that you're talking about?
In our case, we would have 70% as retail, 20-25% as HNI, and maybe 5-10% as institutional in the equities component.
All right.
Right. So our business model is like that. So Sundaram, and it's not necessarily true for the industry. Industry has probably got a slightly higher share of institutional money in equities and a much higher share of wealth segment in equities. We are far more retail. We are far more driven by IFAs who bring in smaller ticket sizes. So we have, for example, I think there are about 9,000 IFAs who get upfront brokerage from us every month. So that gives us a very diverse base of people. Whereas, if you have an institution or you have a wealth boutique, when he takes a call on behalf of his customers, it happens right through the portfolio of that customers. So the volatility of flows in the institutional and the wealth segment is much higher than in the retail. And the second component is our proportion of SIPs also is much higher in terms of the flows that come in. So that's less subject to action in terms of reduction of profit booking.
Mr. Subramaniam, do you, with all your experience, people like us who have just read textbooks, right, and have seen learned from people like you, we have all read about valuation and how the differential between the price and the value of a stock. Do you really believe that that's worth looking at? Because that means you'll have to sell at some point, right?
So yes, you are right. And in fact, the philosophy we follow is the short form is called GARP. It's called growth at a reasonable price. That's the fundamental ethos with which we buy a stock. So ultimately, when we look at a stock, we look at the cash flow model, we look at the growth in its earnings potential, in its cash flows more importantly. And what we do is we figure out a model by which at what price will it give a healthy return to a long-term holding. So the perspective for us, the key here is to maintain a 5-year perspective when you look at a stock. And that gives us a wonderful opportunity, because in between corrections, either because the company disappoints in a quarterly result or because market sentiment for that sector is not good, actually helps us accumulate these stocks as long as they are below that reasonable price benchmark that we have set for ourselves. So growth at a reasonable price summarizes our approach to the whole stock picking model. And so naturally, there are 3 components to this. Assessing what the ultimate stock price is going to turn out, what is the growth in cash flows we project, and so what are the price points below which it makes sensible to buy that stock. And throughout a 5-year time frame, whenever it crosses that barrier, right, we go in and pick up that stock. We don't worry about whether that quarter was in line or whatever, unless there's some fundamental something wrong with the company's business model, a big customer has gone bankrupt, something like that. I mean, leaving those kind of black swan events aside, the philosophy we follow. And so if you look at a mid-cap fund, for example, the top 10 holdings account for about 45% of our portfolio value, okay? But the same top 10 holdings, the average holding period is 4.5 years. So it didn't mean that it all started off in the top 10 and ended up there. It means that it started small, we kept on accumulating so that it came up to the top 10 by the end of the period by a process of steady accumulation.
So I think final question,
summarizes our approach.
Unfortunately, we are a little short of time. One final question, and that is that what happens when the price becomes unreasonable? Sometimes does it happen that your fund managers or you believe that the prices are unreasonable, but the people want to buy those funds because they think that is what is going to give them returns?
So let me explain this to you. Let's say that below, let's say a particular stock, we want to pick it, let's say 30 rupees is the price, which we feel is a reasonable price at which to buy it. So as long as it's quoting at 21, 22, 28, 30, we will buy it, right? Now you're saying fund flows are going to come into that fund. The fund has 50 to 60 stocks. So if the price point is going, let's say at 35, just because money is coming into that fund, it doesn't mean you have to buy that particular stock. We just stop, doesn't mean that when it reaches 35, we sell all our holdings, because our holdings average cost is probably in the early 20s or mid 20s. So it makes sense for us to continue to hold that stock, but it doesn't mean that when fresh money comes, we go and buy the same stock at 35, because we have arrived at the reasonable price in our calculations. So that filter is very, very clear. Plus, the second thing which actually automatically filters is that we have an internal stock limit of say 5% of the portfolio. So in any case, no stock can exceed 5% from a more prudential diversification management process. So even if the stock is available at 25, but we have exceeded 5%, there's no question of us buying the stock. So the overall diversification of the portfolio also helps us that when we want to buy the stock, we make sure it's below the price point that we buy. Even if inflows come in, we go and buy fresh ideas.
All right. Thank you so much for coming in, Mr. Subramaniam, and I really wanted to talk more, but we are very short of time today. Thanks a lot. Pleasure talking to you.